Good afternoon. My name is Kim Schoenholtz. I'm delighted to welcome you to today's program. The program is sponsored by the Stern Center for Global Economy and Business. The center serves NYU through outreach to the broader community, including the academic, business, and policy worlds. We will begin today's fireside chat with introductory remarks of about 10 minutes by President Kashgari, followed by audience Q&A. The session will finish at 6 p.m. For the Q&A portion, please enter your questions through the Q&A mechanism in Zoom. Since we have already received many questions from students and faculty, I will limit repetition by grouping similar questions together. Please note that anonymous questions are not permitted. Let me now briefly introduce our distinguished guest. Neel Kashkari has served as president of the Federal Reserve Bank of Minneapolis since 2016. In this role, he is currently a voting member of the Federal Open Market Committee that sets U.S. monetary policy. He also leads the Minneapolis Fed's many initiatives, including the creation of the Opportunity and Inclusive Growth Institute, as well as the development of the strategy for ending too big to fail that is widely known as the Minneapolis Plan. At the Fed, President Kashgari is a strong advocate for transparency regarding both monetary and regulatory policy. Earlier in his career, Mr. Kashgari served in several senior positions at the Treasury Department. In 2008, as Assistant Secretary for Financial Stability, he oversaw the Troubled Asset Relief Program, or TARP, that played a key role in recapitalizing U.S. financial institutions and bringing an end to the crisis. He received the Alexander Hamilton Award, Treasury's highest honor for distinguished service. Outside of the Fed and Treasury, President Kashgari has had a remarkable and varied career. After working as an aerospace engineer, he helped technology companies raise capital during his stint at Goldman Sachs. He was a managing director and global head of equities at PIMCO. He also ran for governor of California in 2014. President Kashgari received his master's degree in mechanical engineering from the University of Illinois and his MBA from Wharton. I know you will now join me, at least virtually, in warmly welcoming President Kashgari to Stern. President Kashgari, the floor is yours.
Thank you, Kim. It is great to be with you and all of your colleagues at Stern. I really appreciate the invitation and the opportunity to chat with you. As you mentioned, I'm going to speak for a few minutes. I'm going to talk about the economy and COVID and how the economy has evolved and where I see it going from here. And then I look forward to having the discussion with you and all of your audience members. Let me just go back to the beginning of this year, January or February of this year. The economy was in a strong position at the start of the year. The economy was growing. Jobs continued to be created year after year. We were approaching, in my judgment, not yet at what we call maximum employment, but we were getting closer. Wages were starting to rise. And one of the miracles of the last 4 or 5 years is every time we thought we were at full or maximum employment, more workers came off the sidelines as the job market got stronger and more Americans were productive and being able to provide for themselves through private sector employment. So that was a really positive development. And again, the wage growth was picking up, but it wasn't yet taking off, signaling that we were really at maximum employment. So the fundamentals were sound. And then, of course, COVID hit us. You know, at the Fed, we are always looking out for shocks from around the world that could impact the U.S. economy. We run our staff in Washington and staff in Minneapolis and around the system, run lots of scenarios all the time. And a global pandemic was not on our radar screen a year ago. And yet it hit us and it hit the economy very, very hard beginning in February and March. So in response to that, you saw a range of different reactions. The financial markets cratered in March of this year. There was a fear. People ran to cash. They shunned the bond market, whether it's the treasury market or the corporate bond market, and they just wanted to hold cash. And in that moment, the Federal Reserve stood up very aggressively in our traditional lender of last resort function and essentially flooded financial markets with cash to make sure people had the cash that they wanted to calm markets, so there was no collapse of our financial system or our financial markets. And I strongly supported the actions that the Federal Reserve took. We acted even more aggressively in March of this year than we had acted in 2008. Having learned the lessons from 2008, I think we put those into practice aggressively this year. Around the country, you saw a very uneven response in terms of different states taking different actions. We had a very heterogeneous response. Some states locking down very aggressively, some states doing partial lockdowns, a lot of Americans just isolating on their own. We're all watching the news, we're reading the news, and we want to protect ourselves and protect our families. So a lot of Americans said, regardless of what my governor is saying, regardless of what my mayor is saying, I'm going to stay home with my family, take my kids out of school, for example. So at the Minneapolis Fed, sometime in March, virtually all of our 95% of our employees started working remotely. We went all online. I started working from home. I'm in my basement working from home. I'm here almost every day. And so that was the reaction, I think, across the whole country. Even if state policies were different, the citizens in general reacted quite similarly in staying home. That obviously created a very sharp contraction in the US economy. We stopped going out to restaurants, stopped going to the gym, stopped going to movie theaters, stopped traveling, and those sectors of the economy were absolutely devastated. Now, the best news in all of this at the time was that Congress acted so aggressively. Both parties came together. They came together with the executive branch, and they said, we are going to put out the support that the American people need. 20-some million Americans lost their jobs in March and April of this year, which is just devastating, just a record lockdown or shutdown of the US economy. But Congress stepped up. They both stepped up to help unemployed Americans, and they stepped up to help small businesses through, for example, the PPP program, which is several $100 billion programs to try to help small businesses bridge this pandemic. Now, back in the spring, I think many people were cautiously optimistic that maybe this would be a 2 or 3 month event. So the PPP was literally designed to be a 2-month bridge to help all of these small businesses that have been impacted bridge 2 months and then be able to restart, go back to normal in June, July of this year. Now, health experts, I started talking to a lot of health experts around the country. Many of them cautioned me and said, this is likely an 18-month event that we are facing, not a 2 or 3 month event. You know, who knew? Who was right? Turned out the health experts were right. And so the wonderful assistance that Congress provided in the spring was well designed, in my view, not perfect, but well designed, but it was designed to be a short-term bridge. And here we are facing an 18-month pandemic. So then what ended up happening is many people, many states said, okay, we're through it, let's go back to normal. And they relaxed their controls. Yet the virus was not under control when they did that. So take Minnesota as an example. In the spring, when our governor relaxed our controls, our virus count, our case count was still climbing, and yet we relaxed the controls. Then maybe because of the weather, it turned back down on its own, and it went down over the course of June and July. So in early summer, you saw a surprisingly strong economic recovery with a lot of those jobs coming back. But it's a double-edged sword. The economic recovery was strong because we relaxed the economic controls before we actually had the virus under control. And then the virus started raging again throughout the South, and now it's spreading across much of the country. So where are we? We have around 11 million Americans, so down from around 20, 11 million Americans are still out of work who had jobs back in January or February. 11 million Americans out of work is worse, it's as bad or worse than the worst job market in the financial crisis and the Great Recession. So that's still a terrible job market historically. Around 11% is the effective unemployment rate when you consider all the people who have left the labor force. In the last couple months, you've seen a lot of people who thought they were on temporary layoff are now moving to permanently unemployed. And a lot of people who were permanently unemployed said, I've given up, I'm not in the labor force anymore, I'm not even looking. That's really bad news. So when we do the math, we think the effective unemployment rate is around 11% today. And of course, the virus is climbing in much of the country. It's really climbing in my region. Minnesota's climbing, the Dakotas are part of my region. It's taking off, Montana, Wisconsin, and the weather is now getting cold here, which means that we're going to be indoors a lot more. So the conditions are right for more spread. So that's concerning. And our testing and contact tracing capacity of our country has really been overwhelmed, and we are not able to keep up with the needs of testing or contact tracing. And so the virus continues to rage. So the big question now is, what is Congress going to do? Obviously, this is getting a ton of attention in the press. It is just so vitally important that Congress did provide the assistance that they provided. You think about it, 20 million Americans in the spring, 11 million Americans now out of work. How do they pay their bills? How do they put food on the table? How do they pay their credit card bills, their car payment, their rent, their mortgage? If they're unable to pay those bills, it then spills over into other sectors of the economy. And so that's why many people at the Fed, including me, have been outspoken, calling on both sides of the Congress to come together with the executive branch to provide support to the American people. To me, it's three key areas: support to people who continue to be unemployed, again, through no fault of their own; support for small businesses that are directly affected by this pandemic. Thousands have already failed. Thousands more will fail if we don't have more support. And support to state and local governments, because state and local governments employ a lot of Americans, including, for example, school teachers, who we need to be able to do their jobs. And so those, to me, are the key elements of any package that I hope Congress would put forward. If they don't do that, we will end up having a much slower, what I would call a grinding recovery of only slow job recovery and a lot more business failures. And think about this. Think about every restaurant in your neighborhood, in your town, that has gone out of business. I've been surprised in Minneapolis how many blue chip, very successful restaurants have announced that they are closed for good. Not a temporary shutdown, closed for good. Well, every one of those restaurants that closes, or other small business, is now going to be a vacant storefront. And it'll have an out of business sign, and then a for lease sign. And then how long before another restaurant or business forms to take that space, to rehab that space, to hire staff, and to start functioning again? 6 months, a year, 2 years? If we continue to have thousands of small businesses fail across the country, it will slow down the economic recovery, because it will directly damage the productive capacity of our economy. And that's going to hurt everyone. It's going to hurt that business owner, it's going to hurt that community, but it's going to hurt the economy as a whole. And that's why more assistance is critical. There are limits to what the Federal Reserve can do. Certainly we can continue to expand our balance sheet. We can do more on quantitative easing. We're at the effective lower bound on the federal funds rate. But if you can't pay your bills, more quantitative easing is a poor substitute for extended unemployment insurance. And that's only Congress has the ability to put, to get that direct fiscal aid to the small businesses and to the Americans who've lost their jobs and who are facing real hardship. Last thing I want to say before I turn it back over to Kim is the banking sector. Back in April, I called on the big banks to stop paying dividends, and at that point to raise capital. I said 200 billion would be a good number, because we didn't know how big the losses would ultimately be in the banking sector. And here's why. Think about what I said. Somebody loses their job, they can't pay their car payment, they can't pay their credit card bill, they can't pay their rent. Well, then their landlord can't pay his or her mortgage. The longer this goes on, these losses then roll up into the banking sector. And it's anybody's guess on how big those losses ultimately will be. Well, I go back to what I said earlier. The good news was that Congress acted so aggressively to get direct financial assistance into the hands of people who lost their jobs. That's how they paid their bills, their credit card bills, their car payments, their rent, or their mortgage. That's why the losses in the banking industry have been fairly small, all things considered, given the severity of this pandemic. And so what will the losses in the banking sector be next year? I don't know. It's going to depend on what happens to the virus, how long before we get a vaccine that people trust, that people take, so that 50, 60, 70% of Americans have taken it, so that we can all go back to normal, and how much more assistance is Congress going to provide to the 11 million Americans now who are out of work, or the thousands of small businesses that are facing potential insolvency. Those are what are going to determine how big the losses are in the banking sector. And we just don't know. So one of the things that I'm going to stop here is, at the Minneapolis Fed, we took a stress testing model, a publicly available model of the largest banks, and we put it on our website so that people could essentially run their own scenarios of what they think happens to the economy in response to COVID, so they could then see what happens to the banking sector. Because one of the things that's also been true of this pandemic, the range of possible economic outcomes has been massive. massive, much wider than normal. And all of us are, at some degree, all of us are guessing on what the economy is going to do, because ultimately, many of my colleagues have said this, the path of the virus is going to determine the path of the economy. And so the potential ranges are enormous. And we think that giving the public, the informed public, the viewers of this conference, investors, regulators, the ability to run their own tests, their own stress tests by running their own scenarios, we think that that will improve transparency into the health of the banking sector and make banks, ultimately help banks to become better stewards of the capital and the money that they are holding for their customers. So I hope, and on Monday, we're going to be having a conference. Kim's colleague, Steve, is going to be one of the presenters of that conference on the Minneapolis Fed's website. So we hope folks will join on Monday, minneapolisfed.org. But that's it for my brief overview, Kim. I hope that that was a good overview, and I very much look forward to our discussion.
Thank you so much, President Kashgari. That was a wonderful overview. I'm going to be running out of questions real fast. But let me take you back a little bit, because you talked about how the actions of the Fed and the Congress together have helped maintain an important degree of resilience in the banking system, less of a threat to the banking system than might have occurred given the size of the shock. So I would like you to think back to your days as the head of the Troubled Asset Relief Program and talk about the lessons you learned then and how they apply now.
Absolutely, and I've thought a lot about that. One of the biggest mistakes we made in 08 is we tried to be too targeted in our assistance. One of the differences between 08 and now, there's no moral hazard right now. Nobody took risks that they shouldn't have taken, and now they're being rewarded for taking those risks, and this will encourage them to take risks again. In 08, people did take risks. Banks made loans they shouldn't have made. Investors bet on mortgage-backed securities they shouldn't have bet on. Homeowners bought homes in some cases they couldn't afford. So there was a lot of moral hazard, and so many Americans were angry about the 08 crisis, and they said, don't you dare bail out my neighbor who bought a house he could not afford. Don't you dare. He bought a boat, he bought a house, he bought a car. Don't you dare bail him out. So both the Bush and Obama administrations and the Congress designed numerous homeowner assistance programs, but they were very targeted. They tried to help that homeowner who only needed a little bit of help, and who the deserving homeowner, and not help the undeserving homeowner. Well, you know what ended up happening? We helped very few people. Even though our intentions were good, we didn't help very many people. And in my judgment, with the benefit of hindsight, the housing downturn was more severe than it needed to be. In a sense, we tried to save the taxpayer money, but I think we cost the taxpayer money by being too stingy in our assistance. So one of my lessons for this crisis, and I said this vocally when it first came out, err on the side of being generous. Whatever we do, the Fed or Congress, if you end up helping people that didn't really need any help, that is a better outcome than helping too few people. And I actually think the PPP program had that feature. I mean, there's tons of press articles about this company got it or that company got it. Oh, shame on them, they weren't deserving. When you're trying to fight a fire, you're not telling the firefighter, hey, only use a little bit of water. You want the firefighter to put the fire out. And I think that Congress got that message and erred on the side of being generous.
I'm going to have to play devil's advocate here. So let me just take a little bit of a challenge there. So if you think of the water analogy, part of what's being thrown at the economy is more debt. And the federal government's taking on more debt. The Federal Reserve is financing increased debt on the part, for example, of businesses that can't operate through no fault of their own. They don't have revenues, but they're becoming more indebted. How big is the problem created by this rising debt? Is it going to constrain the behavior of the Fed in the future?
I don't believe so, and I'll tell you why. Something happened throughout all of this that I didn't mention in my overview, which is remarkable, is the savings rate soared. So what happened? I mean, I spent a lot of time with my economists understanding this, because the first thing I noticed when I started working from home, I started saving a lot more money. Why? Because my wife and I, my daughter, weren't going out to restaurants, we weren't traveling, we weren't going to the movies, so my savings went up. So dollar for dollar, the reason that my savings went up, and Kim, I bet yours went up too, is dollar for dollar the reason why other Americans lost their income. And so, you think about it, the extra savings that we are generating right now can actually support the additional assistance needed by those folks that have lost their jobs. Because previously we would have been employing them through our spending. Now we're saving more, that savings can be channeled to support them. So long term, there's no question we do have fiscal challenges as a country, mostly driven by demographics in our entitlement programs. But right now, I don't have any concern about the U.S. government's ability to finance the support that our economy needs through this pandemic.
Great. So coming into this shock, banks were far better capitalized than they were back in 2007 and 8, another difference to that period. But in recent years, we've been noticing that it looks like the Federal Reserve has been relaxing some of the requirements on the biggest banks, and capital ratios have actually been edging lower a little bit the last few years. Are we going in the right direction?
No, we're going in the wrong direction. I think the regulatory winds in Washington, D.C., not just at the Fed, at all of the banking regulators have been blowing in a net deregulatory direction. And one of my colleagues at the Board of Governors, Governor Brainerd, has been kind of a strong advocate for holding the line to not let us relax regulations too much. I think we should be tougher. I think we should have higher capital requirements on the biggest banks. You all have done the analysis at Stern. You and Steve have done the analysis. Many others have done the analysis that there is a socially optimal level of capital, and there are ranges on what that is, and it's higher than it is today. And maybe people may not want to go as high as I want to go, but it is substantially higher. It should be substantially higher than it is today. And the big banks will make all sorts of nonsensical arguments that it's holding back lending. It's all nonsense. And their arguments are just, you just make stuff up and you hope people believe it. Banks are, prior to the pandemic, big banks were buying back their stock hand over fist, billions and billions of dollars a year, and yet they're arguing that capital requirements are inhibiting lending. Well, the only way those two things could be true is if they're turning away credit-worthy borrowers and saying, no, we're not going to make a loan to you. I don't think they're actually doing that. And so the big banks need higher capital, not less capital.
So aside from higher bank capital, are there other financial reforms you'd like to see enacted in the next few years?
Well, I mentioned that the banks were strong through this crisis, in part because they came in with higher capital, in part because Congress was so generous. But other parts of the financial sector, the funding markets, the overnight lending markets, they effectively collapsed in March, absent the Fed stepping in as aggressively as it did and backstopping all of these markets. So many of the reforms of money markets, other short-term funding markets that were enacted after 2008 have utterly failed. They didn't do the trick. So I don't have the specific answer yet, but I'll tell you this, I cannot believe that 10 years, 11 years after the 2008 crisis, it happened again. Like, I was told this is a once in a lifetime event. So I said, okay, great. We've got some time to really get things under control. And then 11 years later, it happens again. And that just tells me that our financial system is fundamentally fragile and that the American people deserve better than a financial system that requires the central bank to backstop it, bail it out every 10 or 11 or 12 years. And so I don't know the actual answer yet, but one thing I'll raise to you is, why do we allow firms, financial institutions or non-financial institutions, to fund themselves overnight? Does this make any sense to society? Why do they do it? They do it because they can eke out a few extra basis points of profits in good times. And then when a shock comes, they run for the exits, and then the central bank has to step in and bail it out. That is literally the definition of privatized profits and socialized losses. And I think we can and should do better as a society.
So, the picture you painted of the economy and the outlook, which I think is quite compelling, suggests that we're going to have low interest rates, nominal interest rates, for quite a while. Do you worry about the impact that might have on financial stability and of risk growing over time in the financial system?
It's something we think about a lot. Certainly people point to the stock market and say, hey, you're in a low rate environment. This is a very complicated question. First of all, I believe strongly in the notion of a neutral interest rate, a neutral real interest rate. And so we believe over the last 30 or 40 years in advanced economies around the world, the neutral interest rate has been gradually trending down because of demographics, because of balance of savings and investment. And central banks are managing interest rates up and down around that neutral rate, but we don't set the neutral rate. So first question is, if you accept that we're in a low neutral rate environment for the foreseeable future, one could argue asset prices should be higher because you're discounting cash flows at a lower interest rate. That's not about the central bank. That's about the global economy that we're all in. So I think that that's a relevant factor that we should keep in mind. Second factor is, if we saw frothiness in the stock market, let's say, what could we do about it? The one is we want to make sure banks are well regulated and are sound. So we absolutely should do that. But the idea that we should use the federal funds rate to try to tamp down the stock market, it sounds good on the surface until I stop and think about it for about 10 seconds, and then it doesn't make sense anymore. And I'll give you an example. In 1996, Alan Greenspan declared that there was irrational exuberance in the stock market. 1996. It then rocketed for 4 more years. And if the Fed had tried to use monetary policy to stop the stock market from climbing in 96, I believe it would have had to raise interest rates so much that the recession it would have created would have been deeper and more painful than the recession that was triggered when the stock market ended up collapsing in 2001. So the tool that we have, other than regulation, the tool that we have of the federal funds rate is such a blunt instrument, and it imposes costs on all parts of the economy. I don't want to say never, but boy, the bar is high for me to consider using that tool to worry about things like asset prices.
Right. I would normally say that leaves you with macroprudential tools as the way to try and address these issues. And you did raise that already earlier, talking about non-banks and the fragility of markets that occurred in March. So presumably that's going to be an issue going forward.
Yes.
The Fed has intervened in, let me take a step back. You highlighted just how aggressive the Fed has been this year, even compared to 2007 and 8. You've foreshortened the interventions into a 3-week period compared to what took 18 months the last time around, and done even more. And among the things that you've done is to broaden the range of interventions, entering, for example, into non-financial, the markets for non-financial liabilities like corporate debt, muni debt. Is there a limit to how wide the range of markets in which the Fed should intervene? And if so, what?
I mean, I think there is. I think, for example, directly buying equities, as an example, feels like it'd be a bridge too far. Some central banks have done it. I think it's a bridge too far for the Fed. But just take the corporate bond market as an example. So when the panic and when the crisis hit in March, some sectors of the economy were devastated by COVID, say the travel industry. Other sectors were fundamentally fine, even doing well. Think about food companies like General Mills and Kellogg, companies like that. We stopped going out to restaurants, we went back to the grocery store more, and we bought their products. So their fundamentals were sound. But if companies like that, whose fundamentals are sound, could not tap the financial markets to fund their basic operations, that's how this COVID crisis, this pandemic, would spill over into the rest of the economy. So the Fed stepping in to make sure that the corporate bond market was functioning was simply about limiting the damage so that it did not needlessly spread to other sectors of the economy. So to me, that was a sensible thing to do. And the Fed did it in partnership with the Treasury. So the Treasury, just like we did in 08, the Treasury would put in an equity layer into the emergency lending programs to protect the Fed against losses, so that we are in the monetary space, meaning we're in the liquidity provision space, not in the credit risk space. And I think that's the appropriate place for the Fed to be.
So do you worry, though, that expanding the range of intervention creates some vulnerability for the Fed, potentially a threat to independence?
Of course. I mean, I think that that's fair. For example, we might get pushed to do things like this more frequently. This was clearly an extraordinary event. 08 was an extraordinary event, but might some members of Congress say the next time there's a more modest downturn, hey, Fed, we want you to do all these things. And then I think it's going to be incumbent on the Fed to say, no, we're only going to do this in a truly extraordinary environment. But keep in mind this, if we didn't do this, and if the American people suffered a repeat of the Great Depression, people might be questioning, hey, what good is the Fed? That might also open us up to threats to our independence. So I think that our chairman, Jay Powell, is leading us to be aggressive, but it's also within the bounds of what we should be doing.
So, well, that I guess that comes back to the question of just how far should the Fed be willing to go? Do you worry about not just the breadth of intervention, but the scale or size, or is it just warranted because the shock is so large and there is no alternative that would be satisfactory for stabilizing the economy and the financial system?
I think that's right. And I think part of the reason that the Fed acted so much more aggressively this time versus 08, in 08, each of those programs was brand new. Like, we'd never done it before. What was it going to work? Would it be effective? What would be the unintended consequences of these various lending programs? Would there be long-term ill effects? Would we ever be able to shrink our balance sheet, et cetera? I think we've gained a lot more confidence that we can run these programs. We can run them until they're no longer needed, and we can turn them off. And then we had gradually started tapering down the Fed's balance sheet leading up until this crisis. And so I think we've just gained more confidence in using some of these tools. And that's why we had the confidence to use them this aggressively in this pandemic.
So actually, one point that's I think worth highlighting, the announcement effects from the Fed's new programs, the ones that have dealt with the liabilities of non-financial institutions, have been extraordinarily powerful. The actual scale of the intervention isn't that large. Are you surprised by how powerful the announcement effect is?
No, we're always aware that it's funny, we're always aware that that has the potential to be a powerful effect, but it also means you have to follow through. If you announce it and the markets kind of heal themselves, then you think, well, maybe we don't actually need to stand up the program. No, you still do need to stand up the program for your credibility. And I think that that's been true in the liquid programs, but one program, for example, that's gotten a lot of attention is the Main Street Lending Program, where there has not been an announcement effect. And that's an example where, we can make loans, we can even make loans on generous terms, but we cannot make grants. And a lot of businesses really fundamentally need a grant in this pandemic, and our hands are simply tied. And unfortunately, there's been no announcement effect benefit in that sector.
But it also contrasts with what you had to do in the Treasury market. The Treasury market experienced disruption too, as you mentioned, the repo market, short-term funding markets, all related to that. But the scale of intervention in the Treasury markets is stunningly large. So it's sort of puzzling why it took so much to change attitudes in the Treasury and related markets compared to what it's done in, say, corporates and munis. I'm not sure I understand it.
Yeah, I'm not sure I know either. It may well be that, so many financial assets are benchmarked against treasuries. So it may well be that it was the massive intervention in the treasury market to get that market smoothly functioning again. And then everything that was anchored off of that or referenced against it, people could then breathe a sigh of relief and say, okay, we can get back to normal. It could be.
So turning to a topic that you've been working on, the Minneapolis Fed created this Institute for Inclusive Growth, Opportunity and Inclusive Growth. I was hoping you could tell us a little bit about it and try to tell us how the Fed can use policy to promote inclusive growth.
Yeah, thank you. So when I came to Minnesota, I was really surprised. Minnesota as a state has a lot of strengths. We have on average, a highly educated workforce. On average, we have good schools. We have a very diverse and vibrant business community. A lot of Fortune 500 companies, given our population, we're overrepresented in Minnesota. I was surprised that there are these huge economic disparities, some of the biggest in the nation, racial disparities, wealth disparities, et cetera. And I started asking our economists, why do these disparities exist? I'll give you one example that's a national example. In almost all states of the economy, Black unemployment is twice white unemployment. In a recession, it could be 7% and 14%. In a booming economy, it could be 4% and 8%. And that's true for college graduate against college graduate. It's true for high school dropout against high school dropout. So I started asking our economists, why is that? And what has been done, what can be done? And I found very few good answers explaining why these disparities are there and what one could do to close them. So I actually went to then Chair Janet Yellen and then Governor Jay Powell, and I said, I think we at the Fed need a research center focusing on understanding these disparities. Even if we don't have the direct tools, even if we can't direct monetary policy to one group or another group, even if we don't have the direct tools, if we can focus our research capabilities to try to examine these questions and do the analysis in a non-political, non-partisan way, that could be a real contribution. And then congressmen and women and senators and state legislators could take that analysis and potentially bring forward policy solutions. They liked the idea a lot, and they said, well, we think it should be in a reserve bank. And I said, well, we'll be happy to do it in Minneapolis. So in 2017, we launched the Institute. We've got scholars coming in from around the country, around the world, who partner with us, bring their research into the Fed. One of the things we're learning is that they're helping us to think about these issues in our day-to-day work. Like it used to be, well, the Fed would say, no, we just deal with the median. We deal with the median of the labor market. We deal with median wages. We deal with the country as a whole. We don't think about disparities. I think we should be thinking about disparities. And by the way, this is kind of a long answer. The last few years, we've been surprised at the labor market's performance. We've been surprised that there were a lot more people who wanted to work than the median implied, just based on history. And it turned out the US economy had a lot more potential than we appreciated. So I actually think that if we can weave these disparities and this analysis into our day-to-day work, I think we're going to be better at our day-to-day work of monetary policy and bank regulation for the nation. And by the way, we might illuminate possible policy solutions that other actors could then take forward. So we're early on. I mean, this is a journey that we're on, and we're only in year 3, but I feel like we're making a lot of progress.
So following up on that, there are a number of central banks around the world that are asking the question, how should they think about climate change and to what extent they should incorporate that into central bank policy? What is your view?
Some of my colleagues have taken that view and been quite outspoken. I struggle with it because I asked the question, do we have any special expertise here on climate science? Not that I've observed. And there are a lot of climate scientists in the world doing great work. And if the best scientists in the world tell us something is a risk, I take that seriously. You don't need to debate me on that. I take that very seriously. And then you look at, just for example, monetary policy. We tend to look out 3 to 5 years as we think about the trajectory of the economy and where we're setting monetary policy and what's likely to happen over the next 3 to 5 years. Is the climate changing fast enough that it would come into a 3 to 5 year forecast? Hard to see. I think you can make the case that banks in certain regions of the country that are more exposed to forest fires, more exposed to hurricanes, understanding their portfolios, I think that's directly relevant because those are risks that could roll up right into those banks right away. I can see that. I struggle with saying how it weaves into our monetary policy process just because the time horizons seem to me to be quite different, but I'm open-minded about it. And I'd say one more quick thing. If you look at my region that I'm responsible for, the 9th Federal Reserve District, Minnesota, the Dakotas, Montana, part of Michigan, part of Wisconsin, I hate to say it, but if the world was warming, it might be a net positive for our narrow region. And so this ends up being a very complicated question that I'm not saying no to, but I don't have a clear answer yet.
So since we're talking about monetary policy, at the last FOMC meeting, you dissented. And I was wondering if you could explain to people why and what that means for you going forward and thinking about policy.
Yeah, so I've been a lonely voice at the Fed since I've been there. I dissented, the last time I was a voter in 2017, I dissented in 2017 3 times against all 3 of our rate increases, simply because I said, we continue to have inflation below our 2% target. We keep getting surprised that more people want to work. Wage growth isn't picking up. Why are we raising rates? We're not at our inflation target, and I don't think we're at maximum employment. I don't see why we're raising rates. So I think that has proven to have been correct. So I want to, and now we have revamped our framework for how we think about monetary policy, and it really does take into account what we've learned over the last 3 to 5 years. So I really applaud us for the new framework. Historically, we would say, let's raise rates in advance of getting to maximum employment because we're afraid inflation is going to take off. Well, that didn't happen. And so now we're saying, basically, let's not raise rates in advance of getting to maximum employment. Once we get to maximum employment, then we can raise rates. So I support that in concept. The devil's in the details. And what I objected to was the new statement, the new forward guidance still has us forecasting inflation. It still has us saying, we think we're at maximum employment, inflation has now hit 2%, and we expect it to climb in the future. It's much better than what we did in the past. But for me, it's not quite strong enough because it still relies on us making that assessment. Are we at maximum employment? And do we expect inflation to climb? What I preferred was simply saying, once core inflation has gotten to 2% for a year, we will know it. We will know that we were really at maximum employment and we've really met our inflation target, then we can raise rates. So all I preferred was a stronger version of forward guidance, just to make sure that we don't repeat the mistakes that I think we made from 2016 to 2018.
So if I understand correctly, what you're saying is that the inflation model that the Fed might have used to forecast had limited value, that it was sending false signals from time to time, like raise rates in response to lower unemployment rates. And the shift in the new policy is a bit more backward-looking approach, as you suggest, being patient and waiting to see just how inflation develops. So there are risks on both sides. Why is it safer to be patient about rising inflation?
Well, the inflation models, what did you say? You said had little value. I think they had negative value. I think they misled us and we made policy mistakes. And and the cost of that, what is the cost of that? The expansion was slower than it needed to be. Job growth was slower than it needed to be. Wage growth was slower than it needed to be. And only at the very end of the expansion, we saw low-income Americans experiencing the fastest wage growth. I mean, it is a wonderful development to have the lowest income workers getting the fastest wage growth. But it took 10 years to get there. And that's an awfully long time. And boy, I don't want it to take 10 years to heal and rebuild the labor market after this downturn. So that's the cost of potentially raising rates too soon. I mean, I've really thought this through with my staff. I've examined it. The only downside I can see of my approach is if there's some nonlinearity in the inflation process, which is we finally get to 2% inflation and then inflation just rockets from there, 3-4%, and we're behind the curve, and then we have to raise rates really aggressively. We heard these same stories 3 or 4 years ago, that there might be some nonlinearity in the inflation process. And at the time I called them ghost stories. And here's what I mean. There might be a ghost underneath my chair. I can't rule it out, but there's also no evidence that there's a ghost underneath my chair. And there is simply no evidence for this nonlinearity in the inflation process. And so I think that's exactly right today. So I don't want to belabor this only because I think we've taken a very important step forward. I support us on the step forward that we've taken. I think we've learned a lot in the last few years. My preference would have been to go a little bit further, but I'm happy that we've taken the step that we've taken.
So over the last 2 decades, the Fed has become far more transparent about how it sets monetary policy, including, for example, the update in the statement that was just made a couple of months ago, talking about long-run goals. Are there further steps to improve transparency at the Fed that you think should be considered or actually implemented?
Well, I think we are all trying hard, and everything from it started with Chairman Bernanke and then Chair Yellen and Chair Powell and the governors and the presidents. I mean, we're all, people say, oh my gosh, the presidents talk way too much, which, maybe that's true, but we get a lot of invitations. People want to hear what's going on at the Fed. And so, it's a balancing act. Do you talk too much or are you enhancing transparency? And I think people would look at the same set of facts and probably reach different conclusions about that. I'm active on Twitter. That was an experiment to see, is that a useful way of getting messaging out? I think it is a useful way. There's a lot of noise on Twitter. The signal to noise ratio is very low on Twitter, but there are people that I've come across who are incredibly thoughtful, and I would not have found them were it not for Twitter. So I think we're all experiencing. One of my colleagues, Mary Daly at the San Francisco Fed, she's got a podcast that has, I think, a pretty wide following, which is great. I'm sure there's more that we can do. I'm sure there are things that we can do better. I think the bottom line is we all want to be as transparent as possible. We want to be accessible to the public that we serve. ultimately, we are accountable to them, and we want them to have confidence that we are working on their behalf. And transparency and engagement is the best way we know how to do that.
Great. So negative interest rates in Europe and Japan, and a number of central banks have actually lowered interest rates below zero. The Fed hasn't taken that step. Should it be something that is considered to be part of the policy tool set?
I think most of my colleagues, maybe all of my colleagues and I agree that we've never said never, that it's, under no circumstances will we do that. But we think that there are other tools that could be more effective with fewer of the downside risks. I'll give you a scenario that I've thought of where it could make sense to have a negative federal funds rate. Imagine if, just because of macroeconomic events, the 10-year Treasury went to a zero yield, right? I don't want to think about that, but just imagine it for a second. Could you want to have a slightly positive sloping yield curve for a bunch of financial reasons? Yeah, I could see that argument there. So I don't want to say no, never, but I think, as I said, I think there are other tools, whether it's the emergency lending programs or it's quantitative easing that we would use, or stronger forward guidance that we could use to provide more monetary accommodation before we would need to go to a negative interest rate.
Great. We've covered a lot. One of the questions that comes in is about the apparent disconnect between the high value of lots of risky financial assets and the state of the economy. Part of that is probably related to what you suggested. The Fed is following an accommodative monetary policy. Is that the dominant factor? Are there other things that are driving this disconnect? Is it going to go away, do you think?
I think there are a number of things. One is we're in a low rate environment. And as I said earlier, both the low neutral rate environment and low policy rate environment, and you're going to discount the same cash flows at a lower interest rate, you're going to get a higher valuation, right? Well, your finance students all know that. So I think that's one factor. I also think you're seeing, you talk about the K-shaped recovery, you're seeing some of the largest segments of the stock market are some of the most successful companies that are thriving in this pandemic. The tech companies, as an example. So is that false, or is that real, or is that going to revert? I don't know. There's a story behind it that at least is plausible and rational based on how well their businesses are doing. I also think the stock market is assuming that policymakers are going to continue to support the economy. I think that the stock market says, okay, there may be frictions in Congress right now, but eventually they will come around to supporting the economy. And I think the stock market is counting on that. Whether it's now, it's between the election and inauguration, whoever the president is, or after inauguration, I think the stock market is assuming Congress will do more. So, could they be wrong? Sure, they could be wrong. One of the things that I keep coming back to, and I'm spending a lot of my time talking to health experts, is the health experts that I consult with, some of the best in the country, are more confident now than they were 6 months ago that we will in fact have a vaccine. 6 months ago, they told me, hey, listen, maybe we'll have a vaccine, but there are a lot of diseases for which we don't have a vaccine. Now they feel more optimistic that one of these trials will work, but they keep pointing out, hey, these things take a long time. And you've seen that two vaccine trials have already been halted, at least temporarily. One therapeutic was recently halted, at least temporarily. So they continue to counsel me, probably not till middle to late next year before a safe vaccine is widely available and actually used by most Americans. So that's my base case scenario. Maybe the stock market is also more optimistic about when there will be a vaccine widely available or when there will be a therapeutic widely available. So there could be some repricing as these become clear, as the actual outcome becomes more clear.
So when you lend to firms, either small businesses or larger ones through some of the new programs, presumably you have to take into account structural changes that might make some firms just unviable in the future. It's not just a question of whether, even if you wrote down their debt, would they still be profitable? How do you make judgments like that? How do you, in such an uncertain environment, how do you distinguish between the firms that won't survive even if you wrote down their debt and the ones that would actually would come out of a bankruptcy process and be viable in the future?
Yeah, good question. I'll give you 3 examples of 3 different programs that each do it differently. So first is the PPP program. Actually, at the Minneapolis Fed, we're running what we call the PPP liquidity facility. So banks go out and make these PPP loans, small business loans. They can then bring them to the Fed for funding against that. Now, those loans are ultimately grants made by the Small Business Administration. So the Fed, we're doing no underwriting of the loan. The SBA and their lenders are doing the underwriting whether or not a business meets the criteria. And then the SBA is expecting to forgive these loans, so they are grants. And you're right, there's no doubt there are some businesses who are going to get grants that were probably not viable absent the pandemic, and yet they're going to be able to survive for a few months or a year more because of this assistance. And that goes back to Congress erring on the side of being generous. Again, I really believe that. Better to err on the side of being generous, even if you help some small businesses that would have gone under anyway, than being too narrow. So that's the PPP program. So we're not making credit decisions there. Second, I'll say the the Main Street Lending Program. In that program, we require banks to underwrite a loan and then to keep 5% on their own books, and the Fed will take 95% of the risk. That 5% is critical because that means the bank has a financial incentive to actually do some underwriting and to make investments of companies that they actually believe have a reasonable chance of succeeding once we get through this pandemic. That's why that 5% is there, because we're not in a position at the Fed to go underwrite thousands of businesses across the country. I would note that program has not had much uptake, in part because banks are saying, well, the good businesses that I want to lend to, I want to keep 100% of the loan. Why do I want to spend my time underwriting a business and then give you 95% of the economics? I'll pick the good businesses and keep 100%. So that program has not had much uptake. And then third, the corporate bond support, we're buying against an index. And there again, we don't want to be saying this business is viable, this business is not, this business is worthy, this business is not. So we just said we're going to buy against an index and that way the market is providing information and we're just supporting the market's judgments.
So it's pretty clear why the Fed would want to do that. But Congress has an obligation sometimes to distinguish between the users of funds to which it's going to allocate resources. So, for example, there are some industries that have powerful lobbyists that are able to convince politicians that they need to be supported, but they may not actually be viable in the aftermath of COVID. How should fiscal policymakers deal with that?
I mean, it's tough. And the best example of this is the airline industry. And, they didn't cause COVID, but every time there's a shock, it seems like the airlines are the most fragile industry, that whether it was 9/11 and the terrible devastation from 9/11 or 2008 or now, the airlines are always on the edge. So, I don't know what to do with the airlines. If I was advising Congress or if I was a congressman or senator myself, I don't know what to do. We do need airlines, but I don't know what requirements or constraints you put about, for example, their ability to buy back stock when we're in normal times. It seems like they buy back a lot of stock like everybody else does, and then all of a sudden they don't have any capital when a shock hits. And so they may just need more regulation, not only about airline safety, but regulation about how they manage their capital structure so that they have more of their own resilience that they can rely on when the next shock comes.
That was exactly the example I was thinking of, so I'm glad you picked one. I'm sure there are others. So thinking of structural change induced by COVID, one of the things people talk about is the potential shift away from using office space in big cities. We already see some commercial property rents declining in some of the big urban areas. To what extent is that a threat to financial stability through the exposure of leveraged financial institutions?
It's possible. I'm a little skeptical of some of the more extreme predictions that we're all going to work from home now and we're not going to go back to the cities. My gut tells, I think there is something lost. We continue to hire people at the Minneapolis Fed. So we've got a bunch of new senior folks that I've never met in person. And we do Zoom calls and WebEx calls. It's not the same thing. So I don't think we're all leaving the office forever. But I think there will be structural shifts, just as you said. There may be certain lenders that are challenged by that. There may be certain property owners that are challenged by that. I think more immediately, though, the wave of thousands of small businesses failing That's what I'm more concerned about, because they are tenants in commercial properties, whether it's a strip mall or a shopping mall or an office building or an office park. And if you continue to have waves of small businesses failing, thousands of them, I think that is going to put acute pressure on those property owners and on those lenders, setting aside the long run structural secular changes that you're talking about, which I think are relevant, but I think are going to be slower moving.
Related to the small businesses, one of my colleagues pointed out that we have in the bankruptcy code a chapter 12, which we don't often hear about, which is designed to deal with fisheries and farmers, typically small-sized businesses. And it speeds up the resolution process and allows viable fisheries and farms to come back out of bankruptcy and operate again. But we don't have something equivalent to that for most small businesses. What are we waiting for? How come, shouldn't that be a priority for Congress to try and improve our bankruptcy code to try and adjust for the needs of small businesses? Chapter 11 is too big, not going to work for the small firms.
That's interesting. You know, I confess I'm not an expert on the chapters of bankruptcy, but that's an interesting idea that I'd like to learn more about. So I appreciate you raising it to me, and I want to go look into it and study it a little bit.
Okay. Wow, we've covered a lot. One of my colleagues was very interested in U.S.-China relations, which obviously have been tense in the last couple of years. How do the tensions between U.S. and China affect Federal Reserve policy?
Well, we are modeling the global economy. Our economists are looking at scenarios, and China's economy is enormously important to the global economy, enormously important to the American economy. And depending on what happens with these relations and whether you're going to see onshoring of businesses and supply chains that could affect the cost to American consumers. They'll have some benefits. Maybe we'll be more resilient, but our consumers may pay higher prices. We need to model that, and we need to analyze what does that mean for the U.S. growth economic outlook? What does that mean for inflation? What does that mean for job growth, et cetera? So China is just enormously important. Whether the tension goes down or the tension goes up, either way, China's economy is enormously important to the American economy. So we have to pay close attention to what is happening there, because there will be repercussions for American growth. And that's ultimately what we're focused on. So we look at all these shocks and all these scenarios. Ultimately, we care about what happens to the American economy. That's what we're trying to optimize on our dual mandate goals. So China is very important.
In thinking about the trend for the U.S. economy going forward, to what extent do you think that there will be scarring from the COVID shock that will slow long-run economic growth in the United States?
Well, I think the two immediate sources of scarring are if millions of Americans are out of work for a long period of time. As I said earlier, it took us 10 years to rebuild the labor market to bring them back in, and that is just way too long for them and for all of us. And then the wave of thousands of bankruptcies, and every one of those storefronts that is vacant for a few years, that's a scarring, and that is going to be diminishing our economic capacity until that can be restored. And so anything we can do, it's my opinion is it's much better to spend money on the front end, preventing that from happening, than trying to spend money on the back end to repair the damage once it has happened. I think it's cheaper on the front end. And that's why I hope that Congress is able to come together with the executive branch and provide more assistance.
Great. I'm going to ask one final question to thank you for this excellent discussion. And it goes back to your past. You're an MBA in addition to having a master's degree in engineering. Many of the people in our audience are business school students, both graduates and undergraduates, and they're also alums. So I'm wondering, given your experience, what kind of advice you might have for them regarding their educations, the ones who are here at Stern, and also their careers.
I would say there's been no plan for my career. I've always pursued things that I thought were interesting and challenging. And if they interested me and they were challenging, I would be motivated to do my best, and then I'd probably be more successful than not. And that has proven to be true. Life is long. When you're at school, you're very focused on your first job, and your first job is not your last job. You can do lots of different jobs. I've done lots of different things. And for me, I think you've got to be willing to take risks and try different things. One thing that I noticed that's different about me than many people is I really optimized pursuing interesting opportunities. And that took me all around the country. I zigzagged all around the country in pursuit of interesting new challenges. That doesn't work for everybody. You got to figure out what's right for you. For example, in Minnesota, a lot of people I meet in Minnesota are from Minnesota. They love Minnesota. Their family's here. They want to stay here. And I say to them, that is great. But just keep in mind, you're going to narrow your opportunity set if you're only going to look at Minnesota, or if you're only going to look at New York. And so each of us needs to decide what do we want to prioritize, and then optimize around that. And for me, I was willing to zigzag all across the country in pursuit of opportunity, but there are costs associated with doing that. And so I would just say your career's long. You can do lots of different things, take risks, and pursue things that you genuinely find interesting and challenging, and you'll probably be successful.
So with that, let me thank you, President Kashgari, for this excellent chat. I'm sure that the audience joins me in expressing their appreciation. And to the audience, let me just remind you that on October 27th, we're going to have a follow-up chat with Dr. Geeta Gopinath, who's the Director of Research at the IMF. So once again, many thanks. We look forward to doing this again in the future.
Thank you for having me. I really appreciate it.